Welcome to House Lux Estate, your go-to channel for all things related to real estate and investing. We dig deep into the world of property investment to give you insights and tips that will help you navigate your way to success. Today, we're going to explore a topic that has the potential to change your investment game: the top habits of successful investors that you can adopt. We'll be diving into the practices that set apart the great investors from the good ones, from continuous learning to patience, risk management, and long-term planning. Each of these habits forms a cornerstone of a successful investment strategy, and we're excited to share these insights with you. So if you're looking to elevate your investing journey, you're in the right place. Stick around as we delve into these habits and how you can incorporate them into your own investment strategies. The first habit of successful investors is continuous learning. In the ever-evolving world of investing, staying stationary is not an option. The most successful investors know this and dedicate themselves to a lifetime of learning. Think about Warren Buffett, one of the most successful investors of all time. He is known to spend up to 6 hours a day reading financial reports and books to expand his knowledge. Or consider Ray Dalio, the founder of Bridgewater Associates, one of the world's largest hedge funds. He's a voracious reader who believes in learning from history to make better investment decisions. Continuous learning is not just about reading, though. It's also about asking questions, seeking advice, and constantly challenging your own understanding. It's about staying curious and open-minded, ready to adapt to new information and changing market conditions. So how can you incorporate this habit into your life? Start by dedicating a portion of your day to learning. This could be reading financial news, studying successful investors, or even taking investment courses. Make a commitment to deepen your understanding of the markets and the factors that influence them. Remember, every investor, regardless of their level of experience, has something to learn. The most successful investors are not those who know the most, but those who are committed to learning the most. As Benjamin Franklin once said, an investment in knowledge pays the best interest. Investing is a journey of continuous learning, and successful investors embrace it. The second habit of successful investors is patience. Now let's delve into why patience is not just a virtue, but a critical component in the world of investing. Imagine you've planted a seed. You wouldn't dig it up every day to see if it's grown, would you? The same principle applies to investing. Your investments are seeds that need time to grow. Consider the story of Ronald Read, a gas station attendant and janitor who amassed an $8 million fortune. His secret? A patient, buy-and-hold strategy. He invested in blue-chip companies and held on to those stocks for decades, allowing compound interest to work its magic. So how can you cultivate patience? Start by setting clear, long-term financial goals. Investing isn't a get-rich-quick scheme. It's a marathon, not a sprint. Remember, the stock market tends to rise over time, but there will be dips and bumps along the way. Don't be swayed by these short-term fluctuations. Instead, stay focused on your long-term goals. Another tip is to build a diversified portfolio. This can help you weather the ups and downs of the market, giving you the confidence to remain patient. Lastly, educate yourself. The more you understand about investing, the more confident and patient you'll become. Patience truly is a virtue in the world of investing. So, let's take a deep breath, stay focused, and let our investments grow. Moving on to the third habit, we have risk management. Risk management is a fundamental aspect of investing. It's the process of identifying, assessing, and controlling threats to your investment capital. These threats, or risks, could stem from a wide variety of sources, including financial uncertainty, legal liabilities, strategic management decisions, accidents, and natural disasters. But why is risk management so important? Well, investing is a bit like navigating a ship through stormy seas. The captain doesn't just aim for the destination. They're also constantly scanning the horizon for potential hazards and adjusting the course accordingly. Similarly, successful investors don't just focus on potential returns, they're also always on the lookout for risks that could sink their investments. So how can you manage risk effectively? Here are a few tips. First, diversify your investments. This is like not putting all your eggs in one basket. By spreading your investments across a variety of assets or sectors, you reduce the risk that a single poor-performing investment will significantly harm your portfolio. Second, understand the risk-reward trade-off. Generally, the higher the potential return, the higher the risk. Be wary of investments that promise high returns with little to no risk. They're often too good to be true. Third, use stop-loss orders. These are designed to limit an investor's loss on a security position. Setting a stop-loss order for a specific price will ensure that your investment is sold if the price drops to that level. Lastly, regularly review and adjust your investment strategy. The market is dynamic, and what worked last year might not work this year. Regular reviews will help you stay on top of the market and adjust your strategy as necessary. Remember, risk is an inherent part of investing, but with effective risk management, you can navigate the stormy seas of the market with confidence and poise. You can't eliminate risk, but you can manage it, and that's what sets successful investors apart. Successful investors know that managing risk is just as important as seeking profits. The fourth habit of successful investors is long-term planning. Now, this might seem obvious, but you'd be surprised how many people overlook this crucial step. You see, investing isn't just about making quick bucks. It's about creating wealth over time, and this requires a well-thought-out plan. A plan that stretches out into the future, a vision that outlasts the fleeting trends of the market. So how do you develop a long-term plan? Well, it starts with understanding your financial goals. Are you saving for retirement, a down payment on a house, or your child's college tuition? Each of these goals requires a different strategy and timeline. Next, you need to assess your risk tolerance. Can you stomach the ups and downs of the stock market, or would you prefer a more steady growth investment? Your risk tolerance will play a significant role in shaping your investment strategy. Once you have your goals and risk tolerance figured out, it's time to diversify. No, we're not just talking about spreading your investments across different stocks. Diversification means spreading your investments across different asset classes. Stocks, bonds, real estate, even art or vintage cars, if that's your thing. But here's the thing about long-term plans. They're not set in stone. As your life changes, so too should your plan. Maybe you get a promotion, or maybe you decide to start a family. These changes should be reflected in your investment strategy. Now, sticking to a long-term plan can be tough. It's easy to get swayed by the latest hot stock tip or the panic of a market downturn. But remember, the most successful investors are those who stay the course. They don't let short-term market fluctuations derail their long-term plans. So, start plotting your journey. Take the time to develop a long-term plan and stick to it, no matter how the market ebbs and flows. Remember, investing is a marathon, not a sprint. To wrap things up, let's quickly recap the habits of successful investors we've discussed today. We began our journey by understanding the importance of continuous learning. In the ever-evolving world of investing, staying updated and expanding your knowledge is key. Remember, the more you learn, the better equipped you are to make informed investment decisions. Next, we explored the virtue of patience. Investing isn't about quick wins, but about waiting for the right opportunity and allowing your investments to grow over time. Patience truly is a virtue in the world of investing. Then, we dove into risk management. Successful investors are not averse to taking risks, but they do so strategically. They balance their portfolio, diversify their investments, and are always prepared for potential market fluctuations. Lastly, we emphasize the significance of long-term planning. Successful investors don't just think about today, they strategize for tomorrow. They set clear, long-term financial goals and lay out a roadmap to achieve them. In essence, successful investing is not a product of luck, but a result of continuous learning, patience, strategic risk management, and long-term planning. It requires a unique blend of skills and habits that can be cultivated over time. But remember, every journey begins with a single step, and adopting these habits is a step in the right direction towards your financial success. Now, if you found these insights helpful and want to learn more about investing, we have good news for you. Here at House Lux Estate, we're dedicated to providing you with valuable content that can help you grow as an investor. So if you want to stay updated with our latest content, all you need to do is hit that subscribe button and ring the notification bell. That way, you'll never miss out on any of our insightful videos. Thank you for tuning in to House Lux Estate. Don't forget to subscribe and hit the notification bell so you won't miss our next video. Happy investing!